Hello friends, welcome to this session on accounting, finance and operations, part 2. In the first part, we discussed about basics of accounting, the accounting concepts and the double entry bookkeeping. We also talked about the rules of double entry bookkeeping, how we debit and credit accounts when we apply the dual aspect of transactions. Double entry bookkeeping. Recording is done angles. One account is debited and another is credited. Now we are going to talk about different types of books of accounts which are maintained by a business, the trial balance and financial statements. We'll have some basic knowledge of all these books and other statements. That's the learning objective of this particular part. Now, when we talk about books of account which are maintained by a business, these books are of two types. You'll find it here. We have got primary books. We also call them books of original entry or books of prime entry. These books are further subdivided into journal, which is called journal proper, and special journal. So when we were discussing about double entry bookkeeping, we are talking about debit and credit. So in journal proper, since each transaction has two aspects, we have to debit a particular account and credit another account. And both these transactions, debit and credit, they are to be expressed in monetary terms, in terms of money. So debits, therefore, will always be equal to credits. Like we discussed that we are spending on salaries. So we are debiting salary account and we are crediting cash account. So whatever my expenditure is, the same amount is paid in cash. So debits will always be equal to credits. But when we are in practical situations, we like to reduce our work. Because suppose I am having a retail shop. From morning till evening, I am selling goods. 5 rupees, 10 rupees, 20 rupees, 100 rupees, 500 rupees, 1,000 transactions in a day. So entering 1,000 transactions might be okay, but it takes time. And we also have a system of preparing ledger accounts because I might be making credit sales. So if each transaction, like when each transaction has two aspects, debit and credit, if I debit one account and credit the same account individually, it will consume time, take time. So what we do is we keep some books for entering similar transactions. For example, we have got a purchase book where I enter all purchases. In this case, normally we are entering credit purchases, but cash also, if you want, you can do. So purchase book will contain credit purchases from X, Y, Z, A, B, C, whatever. So when you are making posting of that particular transaction, total of purchases for that particular day, that is posted as a single entry. Instead of, say, suppose you are having 20 purchases in a day. So you have purchased from different people, different persons. So their accounts will be credited individually. That's fine. But purchases account, instead of posting that 20 times, I'll make a single entry, purchases for such and such day, finished. So that is what we do in purchase book. Similarly, we can have a sales book where all sales are recorded, credit sales, and a single entry of the total sales is made in the sales account. Similarly, we have got purchases return book. Whatever goods we purchase, if we find them defective or otherwise, we return them. So all those returns are entered in purchase return book. Similarly, we have return book where all sales returns by my customers, they are recorded. Then for all cash transactions, we have got cash book. Cash sales, cash purchases, income received in cash, expenses received in paid in cash, then cash received from my debtors, cash paid to my creditors, cash deposited in bank, cash withdrawn from bank. All such entries are made in cash book. Then big businesses might have some small expenses. Like if you have got 200 employees, somebody is claiming conveyance of 20 rupees, 30 rupees, 50 rupees. Somebody would buy some small stationery item for 10 rupees, things like that. So what we do is we normally maintain petty cash book. We deploy one gentleman who is my cashier. He is given a fixed amount of money and he makes such small payments against vouchers. And then for, say, if he has made payment to 20 people as conveyance, 10 rupees, 20 rupees, 30, then the total is 500. So in my ledger account, in my conveyance account, a single entry is entered. So it makes my job simpler. So petty cash book is maintained for small expenses, cash expenses. Now when we are having credit sales and credit purchases, we sometimes draw bills and we also accept bills. We don't make the payment immediately. I draw bills on my customer. He accepts that. Similarly, my suppliers, they may draw bills on me. I will accept them. So all such bills, hundis also, we call them hundis in simple terms. So all these such hundis, such bills, payable and receivable, they are separately entered in two different books, bills receivable book and bills payable book. So all these are special journals. So now this journal entries, debits and credits, these are posted in ledgers. So ledgers are called secondary books, books of final entry. Journal is the book of original entry and ledger is the book of final entry. So ledger will contain an account of each expense, each income, each person, each asset, separate accounts. And entries from journal are posted to ledger. So ledger shows you a summary of all these transactions and ultimately we compute one balance. There will be debits in that particular account, there can be credits in that particular account. If both debit and credit are equal, there will not be any balance. But if debit is more and credit is less, the ledger account will always have a balance. Since it is debit is higher in this case, the balance would be called debit balance. That's how we maintain a ledger. Nowadays we have got all computerized accounts, so all this work is being done by computers directly. This is an explanation of the similar things, same things which we discussed just now. Now in general, some of the main books, so journal records transactions on daily basis in serial order, historically, 1, 2, 3. Whatever I incur in the morning, in sequence, I'll be entering. And it's a book of original entry. And ledger, as we discussed, it is a summary, and it shows the net effect of all transactions. That is the balance. And this is prepared for a period. It can have accounts of persons, assets, expenses, incomes. Like we discussed in the first slide, real accounts, nominal accounts, and personal accounts. So real and nominal are basically called impersonal accounts. So personal accounts would be named accounts of persons. So all these accounts are prepared in ledger separately. So cash book would be a record of all receipts and payments which are made in cash. And petty cash book, we just discussed that all small cash expenses, petty cash expenses, they are entered here, and this is a subsidiary book. Now, when we were talking about ledger account balances, so there will be different types of accounts. When we talk about asset accounts means accounts of furniture, accounts of machinery, account of building, account of land. All these are assets, accounts. These are my assets. So they will always have debit balance. Like when, for example, when I buy furniture, I debit furniture account and credit cash. So furniture account will always be a debit balance. So the same rule applies for in case of all the assets. Now, when we talk about liability accounts, the amounts which are payable, such accounts will always have credit balances. It's reverse of assets basically. So if assets have debit balance, liabilities will have credit balances. Now capital, that is the amount invested by the owner's equity we call it. So that will always have credit balance. For example, if I am a businessman and I start a new business, I invest 1 lakh rupees. So it becomes my capital in my books. The entry in my books would be cash account debit to owner's capital account. So owner's capital account, my name would be mentioned there, would always have a credit balance. Now when we discussed the rule debit all losses and expenses. So that means such accounts will always have debit balances. And we had also talked about credit all incomes and gains. So obviously such accounts will always have credit balances. Now when we talk about our credit balance and credit in ledger accounts. So obviously, if a ledger has 100 accounts, some accounts will have debit balances like we discussed in the earlier slide, assets, for example, expenses, and some other accounts will have credit balance like liabilities, owners, equity, your incomes. It's possible that during the year, if you have entered into a transaction with some persons, whether you have sold them on credit, whether you have purchased goods from them on credit, you have settled their accounts, you have made payments or you have received payments from them in full. So in such cases, their accounts will not have any balance. It will be zero, nil. So whatever accounts have balances, whether they are debit or credit at the year end. Normally it's at the end of an accounting period. It could be a month, it could be a quarter, it could be a half year, it could be an year. So at the end of the accounting period, whichever accounts have a balance, we prepare a statement. We write the name of that particular account, and we have got two columns, debit balances and credit balances. All debit balances are written in the debit balances column, and all credit balances are written in the credit balances column. So since we are following double entry bookkeeping, for all debits there is a credit, same amount in both the cases. This trial balance should match. Debit balances total should be equal to credit balances. So we can say that trial balance, we just prepare this trial balance to check whether entries which have been made by us, they are correct. So it's a statement of your debit and credit ledger balances, which includes cash balance and bank balance. And the main purpose of preparing the trial balance is to establish arithmetical accuracy. And as I told you, it's normally prepared at the end of a period, which can be every month, last day of the month, last day of the quarter, or it could be yearly, it could be half yearly, depends. You can do it on a daily basis also if you want, but that's normally not done. And then this trial balance helps us to prepare our final accounts. Your profit and loss account, your balance sheet. Now we talk about the financial statements. Financial statements, the main important, everybody would be aware about the profit and loss account, about balance sheet. So what balance sheet does? Balance sheet shows you the assets and liabilities of business on a particular date. It's always prepared on a particular date. Balance sheet as on so and so, as on 31st March, balance sheet as at 31st March. So on one side you show your assets and properties, and the other side you can show your liabilities and capital, share capital. So since your trial balance has already been prepared, debits are already equal to credit. So when you prepare your balance sheet and make some adjustments which are provided to you, so your liabilities will always be equal to assets. So balances, you know what are the assets of that business, and you also know who is to be paid money by you and what is the amount of capital invested by the owner. Then we come to profit and loss account. We were discussing that whenever you are into business, you are into business to earn profit basically. So at the end of the accounting period, which is normally once a year, you would like to find out whether you have earned profit or not. How much profit have you earned? Because on your profits you have to pay income taxes. So what is the profit earned? It is possible that you have not earned any profit, you have incurred losses. That's also possible. So you would like to know your profit and loss, profit or loss. So how do you do that? On one side, you show your revenue and income, and the other side, from the total of your revenue and income, you reduce your expenses. If your income is higher, you have earned a profit. If your income is less than your expenses, you have incurred loss. So during an accounting period, you find out your profit or loss. So balance sheet shows you the financial position on a particular date, and profit and loss account tells you about the profit or loss for that particular year. Now, in case of companies, when you are preparing the financial statements, balance sheet and profit and loss account, you also give some other information. So one information which has to be given is cash flow statement. During the year, what was the opening cash balance with you? And during the year, from which sources did you receive your cash? And on which account, for what purpose did you make cash payments during the year? And what is your closing balance of cash? So all these items are shown in your cash flow statement. Then we come to accounting policies. A business is supposed to follow some accounting policies. These policies are to be followed consistently, continuously. You cannot have one accounting policy for January and another policy for February, another for March. You have to continue with the same policy during the accounting year. So all these accounting policies which you follow, these accounting policies are based on recommendations by the Institute of Chartered Accountants of India. They've got guidances available, accounting standards are there. So you base your accounting policies. You want to have these standard policies. So accounting policies are disclosed along with your financial statements. And then you have got notes to accounts, which give you explanation about some profit and loss items, some assets, some liabilities. For example, if you have got share capital in a company, so how much shares? What is their face value? What is the issued capital? What is the subscribed capital? What's the paid up capital? So that is disclosed in schedules, separate schedules. Similarly, if you want to disclose what is your expenditure on foreign exchange, what was the salary paid to your managing director? So this forms part of notes to accounts. What is the contingent liability? on account of court cases. Some demand has been raised by income tax department and you are contesting that. So you disclose that as part of your notes to accounts. So all these together are your financial statements. Now when we talk about accounting of banks, the sources of funds in case of banks would be your deposits. Deposits can be of broadly of three categories, three types. Fixed deposits, where money is invested for a particular period, 6 months, 1 year, 2 years, 3 years, like that. Savings account, I think everybody knows what a savings bank account is. Then current accounts, which are maintained for business. Savings accounts are generally maintained by individuals. Then banks can also borrow from Reserve Bank of India. They can also borrow from other banks. In fact, they can also issue debentures or bonds and get money from public. So borrowings. Then their share capital, the money which they have invested. All these are examples of sources of funds in banks. Now these funds are deployed on what? For what purpose? Banks are granting loans, loans to companies, loans to partnership firms, loans to individuals, loans for business purposes, loans for buying homes, home loans, buying cars, for agricultural purposes, for crop loans, for buying agricultural equipment. So all sorts of loans you are granting. Then banks are also investing in securities. It could be government securities, or it could be there if they are having surplus funds, they can also invest in other market instruments. They can invest in mutual funds, they can buy bonds. Then banks also acquire assets. You could be buying a building. Banks might require to purchase computers, furniture. So all these are application of funds in case of banks. Then you also hold cash. You need money. People are coming to withdraw their cash on a daily basis, so you need some cash also. You might be placing deposits with banks if funds are available to you. Surplus is available to you for investment for some time. So you can have deposits with other banks also. So now when we talk about earnings and expenses of banks, banks earn interest on loans, whatever loans they have given, so they earn interest on that. Then they also receive income on their securities, the secure investments which we have made. We receive interest on that, we receive dividend on that. Then whatever deposits we have placed with other banks, or for example companies also, you receive interest on that. Then banks also receive fee for services rendered by them. Like if you grant a home loan, you charge home loan processing fee. So that's your fee for services. You issue a draft, you receive commission. So all these are types of earnings of banks. And the expenses, major expenses are interest paid on deposits by banks. And if banks borrow, they might be paying interest on borrowings. And they also have their other expenses like staff expenses, rent expenses, electricity expenses, things like that. So friends, we are concluding this second part. Thank you very much. Have a nice day. We'll meet shortly for the third part. Thank you.